Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending Jan 18, 2019. Boy, what a series of months that we've had. Looking back in Q4 of last year, cranking it off, October was the worst month since 2008. We were down about 7.2% in the S&P. NASDAQ was down almost 10%. December turned out to be the worst month since 1931. And we saw, I think, about 70% of the S&P 500 companies in official bear market territory. And now we've kicked off 2019, and the markets are just blasting higher. The S&P is up 6.5%. It's its best start since 1987, and the Dow is up just slightly under 6% at 5.9. And it's the best start for the Dow since 1997. And this past week, we've seen all indexes posting solid gains. In fact, looking at the sector performance for the week, the standout performer was financials, which has really lagged everybody in 2018. It was up 4.75%, the financial sector. The worst performer was the utility sector, down only about 11 basis points. And this past week, we saw, kicking off on Tuesday, we saw JP Morgan, Wells Fargo. We had First Republic Bank, I think, on Tuesday. Wednesday, we had Bank of America, Bank of New York, Goldman Sachs, PNC. We had BlackRock, U.S. Bancorp. Thursday, we saw BB&T, Key Corp, Morgan Stanley, American Express. Friday, we got some more regionals with SunTrust Bank, Kansas. Excuse me. And then we had State Street. A lot of banks kicking off last week. And while the earnings were not stellar, they were better than expected. And it was enough to move the financial sector to the best performer for the week and a strong week for all the markets. So we've seen a huge move to kick off 2019. We're still seeing numbers coming in, but we saw last year that earnings grew an estimated about 22% for last year. Yet the PE ratio fell dramatically. In fact, it was one of the largest falls in the PE ratio when the markets bottomed on December 26th. It was the fifth largest drop since the early 1940s for the price to earnings ratio. Amazing. And UBS analysts ran some stats on that, and they said when you've seen a large scale drop in the PE ratio like that, in this case, the fifth largest, not since 1940s, generally the next 12-month period, the markets return about 16%. So, it's boding well for a strong 2019, even though there's a lot of potential turmoil on the horizon. Earnings growth is projected for 2019 to come in about 5.7%, which is around 15.4 times forward earnings. So that is below average, and because the bar is so low, it's not going to take a lot for corporate earnings to beat. And should they do that, then that's going to give a boost to the markets. Now, there's still headwinds out there. This past week, what really goosed the markets, we've got the China-U.S. trade tiff. And there was news coming out of the White House that they're going to suspend all the tariffs in order to really move this trade deal along with China. China also tried to throw some money in the pot by saying we'll offer up $1 trillion in new spend for U.S. goods and services. And all of that was enough to really just jack the markets this week. Okay. So we've got the China trade tiff there. We've got the Brexit that's going to come to a resolution here shortly. We've got the U.S. political dissonance, which is still going on with this government shutdown. And most analysts believe if it continues into March, it's going to begin to weigh on the U.S. GDP for Q1. So there's a number of issues floating there with that. We've got earnings growth and recessionary growth starting to appear stronger across Europe. And of course, one that I keep harping on is the credit markets with the government, or not the government, but corporate bond markets. A big part of investment grade corporate bonds are at the lowest level, triple Bs. one more tick down and they go into junk, which means it's going to force a sell by a lot of pension funds that can only buy investment grade bonds. So there's clearly enough issues out on the horizon that you can't, take a nap in the hammock. You got to watch very closely. Now, what you see on the screen here is a daily chart of the S&P 500 futures. And you can see it has formed this perfect, while pretty rare, V bottom. I mean, we've come down like this, and then we've gone up like that. That is a V bottom. And there's still a lot of analysts that do not believe in this side of the V, meaning it's going to have to come back down before we can really start moving up in this area again like that. It's very rare to have just a slash down and a slash up. But, stranger things I've seen in this market can happen. Some analysts are expecting us to come down and test the 2018 close. So for all practical purposes, that was at 2505.25. So you can see we're well into the green for the E-mini S&P 500 futures. And there are the lows for 2019 that were right at the beginning of the year. And then we just bounced off those. And then, of course, we got the 2018 lows just sitting right there. So we're going to watch this very closely. I am expecting a little bit of a pullback. I'm of the opinion right now that the lows that were made on December 26th, they've been cast. If we look at this chart, you can see here 2316.75. That was an intraday low made by the S&P 500 E-mini futures. Okay, I'm of the opinion that the die was cast, and it moved us over 630 points from the highs made in September, and it put us in a bear market territory until we were able to climb back out of it within the next day or so. But we did officially move into a bear market territory on that flush out on the 26th of December. Now we've got this V bottom. You can see this red line is the 50 EMA. We've climbed above it. There is the 200 EMA sitting just north of the current price. So when I look at this, I said that we're going to be in this battle zone from 2600 to 2800. If you look at my market map, and this market map, I've got it programmed to go back 90 days in time, so roughly about a quarter or 90 bars. So on a daily chart, that represents a quarter. And if we step it out, you can see the three previous market maps where the price action seems to hold up. And the yellow line that you can see is where the highest volume took place within that time frame, that quarterly time frame. And you can see we're now sitting at a major area here that is going to be very difficult for us to move much higher. If I were to extend this, there's one line right there, right? And then here's another major resistance line right here. And then here's another one right there. All of them roughly, and then here's our price right here, right? So we've got a lot of resistance sitting above us. We've got some fairly good support sitting below us. And I'm using the psychological number of about 2603 because that was an area there that held up for us as we came down in November, October, and then we made it two failed attempts at a rally where we had a high, a lower high, and a lower high. And then we gave it all up in the month of December. And then you can see when we broke that area right there, we gave it all up. And then we had the flush out. So this could be considered like a capitulation type of move. And I know there's analysts and folks out there that believe we're going to come back and do a retest, and we may. But right now, the charts don't seem to indicate that. The charts seem to indicate, and you can see the Elliott wave count on my screen here has switched over, and we're in a 1, 2, 3 pattern. This 1, 2, 3 pattern suggests that, and you can see here, there's 1, 2, 3. It suggests we're going to run into resistance here, come back and do a 4. And then that would set us up for a 5 move somewhere up in this area here, just south of the 2800 level, just like that. Now, Here's the 200 EMA. It has now gone flat. All right. The 50 EMA factor is starting to point up just a little bit. So I am going to use the 50 EMA as my hard and fast support area this coming holiday shortened week. Monday is a holiday. The futures market will be trading Sunday night into Monday. Okay. And then the futures market via Globex will close Monday at 1 p.m. Eastern Standard Time, 12 noon Central, I believe. But this is the pattern that I'm going to be looking for to take place. Now, should we come back in and we move down here and take out our 2018 close, which for all practical purposes measures whether we're in the green or the red for 2019, should we take it out, then I'm watching that area right there. But these are at key levels. Notice we got a key price level here at 2603. We've got an opening price here at 2505. So these are at 2600, 2500. And then the next huge area right is up in this area here from 2700 to about 2735, which is where we're looking at that next key value area on this chart here on, where volume is, where buyers and sellers met equilibrium. So I would expect, this momentum can carry us higher, but I would be setting some tight stops, looking for a little bit of a pullback into this week or next week. Now, that's kind of how I'm seeing the markets drift right now. If we look at the Russell has outperformed them all. Again, they're all V bottoms, okay? So if we look at the Russell here on this chart, you can see here that overhead, the value area is at 1530. We closed Friday at 1484.30. So we're looking at about another 60 points higher for overhead resistance. Notice we've cleared the 50 EMA. And notice how many days we spent at the 50 EMA. 1, 2, 3, 4, 5, 6, 7. We moved above. We closed almost right on it. It was starting to hold. So over 7 trading days before we're able to get some lift above the 50 EMA. Now, for our members, I had recommended a pair trade because on Sunday evenings we do our weekly market watch. And for about a month, I was pointing out the severe underperformance of the Russell compared to the SPX. Huge underperformance. And I said a pair trade is in the offering here, where you're going long IWM and you're selling the SPYs. And on a relative basis, the Russell has caught up, and it turned out to be a really good trade. And you can see that move here. If you've kind of sat on the sidelines with this V bottom, where you were forced out in December and then you've not jumped back in again, don't have this fear of missing out, this FOMO mentality that you've got to jump in right here. I would say the odds of a little bit higher are better than 50-50, but the downside is where the risk is now, just to kind of settle out some of this big move that we've made. Okay. But again, we're above the 50 EMA, but we're still in a damaged frame of mind, right? The 50 is below the 200. So the 200 is also kind of sitting around our value area. So that's going to serve as a resistance point. If we look at NASDAQ, again, a V. Now, the nice thing about the NASDAQ is we're closer to the 200 EMA. We're sitting right on our value area here. So there's a ton of overhead resistance here. The Elliott wave count, just like our Russell, has changed to a 1, 2, 3. Now, remember, the 3 leg in an Elliott wave pattern is the big move, right? It is the longer duration move. Then you have a pullback in a 4 leg and then a move higher, a 5 leg, before you have a more of an ABC kind of capitulation pattern before the markets determine where they want to go next. But again, this big move off the lows here, we're into the resistance this week is going to be a lot tougher than last week. I think last week, this previous week, the reason why we exploded higher, the bank earnings, all of those banks that I mentioned came in better than expected. I mean, everybody was expecting the worst. Everybody was geared for the worst. And their net interest margin and their loan growth was okay. So that fear just got sucked right out of the market. So there was kind of this relief rally that took place, that the banks, okay, kind of a canary in the coal mine for the rest of the markets. They did okay. So now we got more earnings coming out this week, but we could see a little bit of a sideways to chop to slightly down. So, and we've got a number of other issues, pressing issues with the market that have to be resolved. And also on the back of the news, as I mentioned on the China trade tiff, with Mnuchin coming out saying that we're thinking about pulling the tariffs just to force this thing or to put it on the table. And I don't believe that's true. I think Trump had come out and said he didn't say that. So they're goosing the market. China also goosed the market with their $1 trillion bribe, as only China knows how to do. So we're only a couple of tweets away from coming back and giving up a big part of this gain, right? I mean, really a big part. If I were to run, and it would be the same with all of them, but if I were to run a fib node right here on this, let me just put it like this. Let's go like this and run it like this. Like this. You could see right in this area here, a pullback to 50%, which puts us almost right on the 2018 close, which would put us back at zero for the markets. And I suspect most of them are very similar to this. So a 50% retracement of this V move, to me, I would live with. And in fact, I would not be surprised if we got it. Okay. Now, if we look at the Dow, well, the Dow futures, same thing. It was, I mean, the Dow futures for the day was up 400 points. It's just as close as NASDAQ to the 200 EMA. Okay. You can see this huge move down, this more or less a V bottom as well. You've got this value area here sitting around 25,002. Taking out the 200 EMA, the 50 is still below. Oftentimes, when you get into a 50 below the 200 EMA, the failure is not as much at the 50 EMA as it is at the 200 EMA. So if we fail and start moving down, I think the algos are going to kick in, accelerate the move to the downside, and we'll find ourselves down around the 18 closing price or the 2019 lows that were made early in 2019. So again, it would not surprise me. Now, one other thing I wanted to show you, or at least another look, let me just show you the look of the E-mini S&P 500 futures, but with Bollinger bands put on them. You can see here, and I pointed this out to our members a number of times, and we passed one hurdle. In early November, we were stopped out at the 1 standard deviation Bollinger Band. This is a 2 standard deviation, and this is a 3 standard deviation. So traditional Bollinger Bands run 2 standard dev. But what I did was I superimposed 3 Bollinger Bands on top of each other with the center being the same for each. So in this case, the yellow is the 20 EMA. And you can see the sharp move higher here. But you can see where we couldn't get up to the 2 standard dev right here, and we failed right there also at the 1 standard dev. So the 1 standard dev, we failed both times. And then in December, we moved down and we came right down to almost that 3 standard dev, which is really amazing to me. Okay. Now, as we move back up, you can see we held up there at that 1 standard dev, and I was expecting that to continue, but then we just got this rocket ship higher here. Now we're sitting almost at 2 standard dev. So to me, a pullback to the center of this Bollinger Band to me would make sense. Now that's a pretty good little pullback. That takes us below 2,600 down to about 2,550 area. Okay. In the E-minis. So that would give us a little bit of a pullback. Now, it doesn't look like a lot on this chart, but that's what I would be expecting. I've also superimposed off the bottom here, Fibonacci extensions off the bottom. And this is the 50% area right there, right around 2631. And that area would be kind of like the final area of resistance. And then coming back down into this area right here, And you can see it's an area that has provided support right there for us. And this area here, the 50% level, well, it was support here. It was support here. We hung up here, and now we're just sitting slightly above it here. So there is a support area here and a support area here on a pullback. We are in this Elliott wave 3. That would suggest a pullback to a 4 like that, and then a rocket higher for a 5 somewhere up there. Okay, so the charts are lining up that would suggest a little bit of a pullback here, and we're north of the 50 level on the RSI, but we're not overbought. So that does suggest the momentum can carry us a little bit higher. But if you're, again, as I said before, if you weren't long the backhand side of this V move, I would not jump in long at this point in time. I think the risk of the bigger move is to the downside rather than the upside. Okay, so that would be kind of the way I would be looking at that chart. Now, if we come over here and look at VIX, I've been short VXX shares since up in this area here. Okay, truth be told, I got short up in this area here, took it in the shorts a little bit here, but I held on to the shorts, and now, they've done very well on this backside move here. This is the opposite, if you guys can think about it, of the V move that we had in the price action, right? This is just the opposite, because VIX moves generally in the opposite direction of the market's volatility. We got up into this red zone up here right around the 36. And for those of you that are members and follow us, when you get up in this area here, you darn well better be looking at picking up some puts in VXX or playing the VIX to the downside, because the odds dramatically favor a pullback. Okay, and you don't need to stay in the trade long. And then we move back down into the yellow zone. So we closed the week last week at 17.8. We haven't been back down here since early December, before the markets really crashed, right? We had a little bit of a move higher in November, and then the markets just gave it all up in December. And this was the December flush out right here. So if we look at where the markets have moved, you can see here, since the market started moving down in October, we had an early October flush in here. And then November, the markets tried to bounce back and volatility came in, never moving into the green down in this area down here. Okay, so the volatility was elevated, but then December flushed us out. You can see here this dividing line between November and December right here. I'm not drawing it very straight, but my mouse is going crazy. But you can see, looking here like this, we had the flush out leading to December 26. And right in this area here is when, around the going into the holiday break was the time to pick up VIX puts or VXX puts, right? Now, I just, rather than playing the option market, I shorted VXX ETNs, okay? And now we're back down in this area here. So it turned out to be a really nice trade. And that's what you've got to look at there from a contrarian standpoint with volatility. When you get a low-hanging fruit trade like that, you got to take it, okay? Now, if we come in here, and let's just get some of these off the screen here, and we look at bonds, interest rates here, since we started the October move, which was right in this area here, October, November, December, and then right here, interest rates came down dramatically. This is bonds. So when interest rates go down, bonds go up, okay? And then we've had a little bit of a capitulation here with a little bit of a rise in interest rates. Again, this was a chart I was showing our members Sunday evening, looking at interest rates as it works in comparison in the credit markets with other pair trades. And it suggested interest rates were going to come in. And that's exactly what they did. If we look at the 10-year rate here, this is the chart of the 10-year rate. You can see here we had a great divergence, and the time to go short TBT was right here at the beginning of November. And that was, and you could have just as easily gone short here, but we didn't have a signal here. Our signal was over here in November to go short. And you can see here this value zone We hung up here. It caught us in late October, and then it held up just a little bit. And then the minute we went into December, interest rates cratered. And this was, if you guys will recall, when Power Ranger Powell came out with Helicopter Ben Bernanke and with Aunt B, aka Janet Yellen, and basically they all reaffirmed that they're going to take their foot off the accelerator for interest rates. But more importantly, they suggested that they're going to be data dependent for quantitative tightening, which took liquidity out of the market. So now we've got this huge flush out here. Where will interest rates go for 2019? I think it's going to be a very interesting story. The Feds, if you think about it, have not changed their dot plots yet. They've still got 2 interest rate hikes on tap for 20.